Okay, so sorry about that. We are going to jump into, we talked a little bit about this in the acronym class about loan to value. And so we'll jump into that. There's actually 3 different ways to calculate different loan to values. One of them is just your first lien position. I'll go over some examples of like a client that I'm working with right now that has LTV, CLTV, and HCLTV. So we'll go over a real life example of how that works. And then we're going to jump into income and calculating income and different types of income. And I know we touched on that in a class as well. And you'll have to forgive me, sometimes the classes blend, and so sometimes I think we do it in the originator training and we actually do it in the processor, or vice versa. So I just don't want to think that I did it in here with you guys and then actually did it in a different processing class. So let me just get this stuff going. Okay. All right, loan to value. What's that joke that you told the kids? If someone has a kid named North, South, and East.
Oh, the riddle?
Yes, what's the riddle? This is pertinent. I need you guys to know this. Oh, come on. Okay, so like, if someone has 4 kids and their names are North, South, and East, what's the name of the 4th?
If someone's mother
Yes, thank you.
has 4 kids.
Tell the riddle.
Okay. If someone's mother has 4 kids, their names are North, South, and East, what's the name of the 4th child?
Someone.
Yes. But, yes, but, right? If you think about it too much, you will never get that riddle. Okay. So sometimes in this business, the answer was someone. The answer was someone.
Oh.
Right? If someone's mother has 4 kids named North, South, and East, what is the 4th child's name?
Wow, that's good.
Right? Okay. So I'm telling you that because some of these things you're going to overthink. LTV. Okay. It literally means loan to the value of the property. Okay. Oh, see, this is why I hate this camera, because it just does not show that stuff as well. Okay. So how much loan amount compared to the value, which is either purchase price or appraised if it's a refi, or AVM, or whatever your value is if you get a PIW. Okay, PIW is a property inspection waiver. It means that you put a value in for the property in your system, ran to you, checked pinged the sites on the back end for validation, said, yep, that's a good value, we'll let you use that, okay? It's literally the loan against the value. Okay, so where it gets tricky so the first place that it gets tricky is if you have a first and second. Okay, so you have different combinations or calculations for loan to value. So you have basic loan to value is going to be your first lien against the value of the home. So what you'll see in a lot of operating systems is you might see, let's say, so for all of the math we're doing today, okay, we're going to use an $80,000 loan and a $100,000 value. really easy math for me. Okay, so if you have a first lien over value, if you have a first lien of 80,000, a property value of 100, then you're 80% LTV. And what you'll see in a lot of systems is when it's doing LTV, you'll see it like this, 80, 80. And what this means is there's no secondary financing. No HELOC, no second loan, no silent second grant, anything, nothing back here. Okay, now, CLTV is combined loan to value. So you're still going to have your first lien here, and then you're going to have CLTV here. Okay, the combined loan to value is going to take into consideration anything beyond the first mortgage. So let's say we have another 10,000 here.
Could you repeat that, please? Because you had your sound cut out.
The CLTV here is going to include anything after a first mortgage.
Okay.
So we have our first, okay, so we have our first at 80, the second or HELOC with 10,000, then your LTV is still 80, but your CLTV is now 90 because we're 90 of the 100,000. Okay. If this is a HELOC, and let's say the HELOC is really a 20 grand HELOC, okay, but they've only used 10,000 of the HELOC, then you're 80% LTV, 90% combined loan LTV combined, and you're 100% HELOC combined loan to value, meaning that regardless of how much they have used, what's available to them. If they max this out, what is their loan to value going to be, which would be 100%. Now, you will see people talk about, and you will see posts in forums, and you'll see people say, hey, anybody know of an 80, 10, 10? 80, 10, 10. Or an 80, 10. Meaning on a purchase money, can they do 80 on a first and 10,000 on a second? Hold on, I gotta make sure this went through real quick. Give me 1 second. Okay, good. Now, if you see somebody say an 80, 10, 10, okay, this is the down payment. So we want, basically what we're looking for is 100% financing. Why would somebody do this? Oh, shoot, I got somebody waiting in the freaking waiting room. Sorry, Brooke. Okay, so why would somebody do this? Well, what happens right here? no PMI. Okay, so you're going to take a first at 80% and a second lien at 10%. Even if this rate's higher, the total payment to do it like this versus 90% loan to value and PMI is still probably going to be less. So if you have a debt to income issue or a 90% loan is more than your county loan limit, you would do the maximum county loan limit on the first and do the rest of it on the second, minus their down payment. So you might see an 80, 15, 5. Okay, 80 LTV on the first, 15 LTV on the second, for a total of 95 loan to value, and the borrower's down payment contribution is 5%. Okay.
So what is a HELOC?
Okay, so a HELOC, the difference between a HELOC and a second is a HELOC is going to be a revolving line of credit. So a second mortgage is going to be amortized and scheduled payments out over the term. So the term is going to be the number of years or the number of months. So most people are going to get a second mortgage either on a 20 or 30 year because it's a smaller amount. So it's a smaller payment. And when you pay off that a true second mortgage, when you pay it off, it's closed. On a second mortgage, if you borrow 20 and you pay off 10, you can't go back and use the other 10 again. Okay, a HELOC is like a credit card tied to the equity of your home. If you have 20, let's say you have 20, you use 10, you pay on it all year, don't use anything again, and then you decide you got to pay the deductible for windows, so you want to draw another 5 out of there. It stays open. Even if it goes to a zero balance, it doesn't close out. So a HELOC is more like a credit card tied to the equity of your home.
Okay.
Okay, so that's why you would have an HCLTV. Now imagine if we had this scenario. So the first loan is 80. The HELOC is, let's say it's 25 when we got it. Let's say it was 25 when we got it. Okay, we're doing a refinance. The appraisal comes in at 100. They're not going to let you keep the HELOC at 25. And when you go to request the subordination, meaning let us refinance the first and leave the second in play, the second lender is going to decrease that HELOC to 20 because your HCLTV is 105. If this stays at 25, you have 5% more in ability to incur debt, 5% more than the value of the home. And they're not going to do that. Most places are not. I don't even, like, I'm not an expert. I don't know every bank. I don't know every lender's guidelines. I don't, especially because these are going to be community banks or hard money lenders or whatever, right? So like, the only time somebody would lend you more than what it appraised for is if it's like, you can prove that whatever you're putting into the property is going to have what's called ARV, which is after repaired value. Like, let's say your kitchen burned down, I don't know, this is like a wild thing, but like, let's say your kitchen burned down and you still needed to have this 25K because you were going to rebuild and you want to put extra stuff in it. Okay, but if you put that kitchen and you upgrade it, like right now it's only worth 100, but if when you're done, it's going to be worth 115. Okay, they would let you keep that because your combined loan to value for the full HELOC amount is going to be less than 100. Okay, I went really fast on that. Like, you guys, I come across this like twice a year. Okay, so in the realm of things that are really wildly important, it's not. It's just to give you the exposure, because a lot of times what happens is you don't know about this stuff until it's in your lap. Okay, so the point is to bring these things up for you. The other stuff, the 80-10-10, the LTV, CLTV, you'll come into that pretty often. pretty often. Depending on the type of volume that you're originating or processing, that's something you'll come into very, very often. Okay, so you don't always, so like, if you don't know these things, what'll happen is you'll get, I thought a Heloc can only go up to 80%, and can a Heloc go to 100 LTV, or is that just an example? It depends on the lender. So we have a local credit union in Colorado, Red Rocks, that will go up to like 97. So that's why I'm saying, like, I can't speak to all of the terms of all of the lenders and what they will and won't do. It's the position of the second lien holder. The second lien holder, the company that's issuing the second mortgage or the Heloc, will determine the max LTV that they will lend to, or the max HCLTV that they will lend to. And no, Helocs can go above 80. That's the reason why you would use a Heloc, is to go higher. Okay, so the other thing that happens is, that you may come across, like, especially for people in areas where there's low loan amounts. So for example, in Colorado, if you go just north, I would say just north of Brighton, so it's about 40-45 minutes north of Denver, into like a small place called Loch Buoy. It's a growing, and Keensburg, it's all growing. But for a long time, it's been considered rural. And so the FHA loan limits have not caught up in that area. And the really unfortunate thing is, like, these builders are going out there and they're building these homes. And I think a lot of people didn't realize when they started doing this that they price these homes above the FHA loan limit. So what I'm saying is here, let me just Google it really quick. Okay, so in this area, because there's such a need for affordable housing, what happens is anywhere, right, is that building and affordable housing tends to get further and further and further and further out from the main cities. Okay, further and further, because the land is less expensive and the ability to build becomes more cost effective, which brings the housing price down, and then people can afford to buy. So in 2019, whoops. Okay, the loan limit for Weld County was 331,760. However, some brilliant developer went out and started building, and okay, so there's some people in Colorado from here, and I'm just gonna fucking say it. Okay, so LHI Homes, it's a builder grade, even like whatever builder grade in, this is lower than that. Like sheet linoleum, Formica countertops, you know, faucets with the plastic crystal knobs on it, okay? It's new, but it's shit. I digress. Okay, they started selling these homes at $350. Okay, with no upgrades. Okay, so if you didn't want the fancy plastic crystal knobs and you wanted, you know, just brushed nickel, or you didn't want a black appliance package, you wanted stainless steel, it went up from there. But this will serve our purpose for what we're going to talk about. Okay, so if you put if you put 5% down on this, okay, if you put 5% down on this, then you need a loan amount of $332,500. Okay, not a super big deal. It's only $300 above the loan limit. Okay, so, or 800. Okay, so the borrower would need to bring whatever in cash above this dollar amount. But then what happened is, y'all, I'm not even joking when I'm about to tell you this. People would go and line up on a Saturday morning at 8 o'clock, and they were assigned ground stakes with a flag on it, and they were assigned a number. And at a certain time in the morning, a bell would ring, and hundreds of families would run to these dirt lots and put their stake in the ground and claim their lot in order to buy these. Okay? Just giving you an idea of how desperate affordable housing was. So what happened is, by the second phase, these were $399. Okay, so $399, whoops, times 95%. $379.50. Okay, that at this price with 5% down, this was the loan they needed. Okay, now it's a big deal because that's $40,000 difference from the loan limit. Okay, so what was happening is, and this is to be insured by HUD, Fannie, Freddie, FHA. Okay, so then what happens is people couldn't buy these homes because most lenders didn't realize, like, okay, if I do an 80, let's see, what would this be? So $399 times 80. So an 80 would be $319, $200. And then I would need to get, so 319 minus 379. So I need to get a 60,000 second. Right? So it would make that like a 15. Then you can do this loan because the first, even though it's at 80, we just do 80 just as a starting point, right? But now the first at 319 is below the 331. Now what you could do is max out the first to the 331. So let's say that was like, let's say it was like 84, and that would be 11. Okay, does that make sense? So a lot of times lenders would walk away from this because they'd be like, it's over the county loan limit. Okay, but the way you do that is you make sure the first is at the county loan limit, and then you do a second or a HELOC for whatever's over up to the guideline for your second, or the guideline for your lender. Now you have to be careful because some lenders might say like, hey, that's cool, you can do secondary financing, but we're gonna cap it at 90. Okay, so the borrower's gonna have to do 10% down. You're gonna have to know the guidelines on that. And there's not really a lot of overlays until you get into multiple, oh my God, you guys, sorry, multiple units. So like more than one unit or high balance. Okay, any questions on this before we move on?
I'm good.
Thank you.
Will this be gone over again?
Probably not.
That's okay.
Probably not. But I have some exciting news, so no worries.
What's that?
Oh, we'll talk about it. Okay. I wanted to do this TikTok where it was like, when your morning coffee becomes your afternoon coffee, and then just take my cup of cold coffee and pour it into a cup of ice and be like, afternoon coffee. Okay, so LTV, CLTV, HCLTV. Okay, you got to get creative in making these work. Now, income. Income. Okay. We're going to start real basic just to get started because we're going to spend a lot of time in the, what is with this here, right here? I'm not going to be able to focus. Okay. Okay, that's income. Don't over, okay, debt income, DTI. So how much debt to how much income? Okay, cash flow, how much is going out versus how much is coming in. It's just a percentage, okay? So you have two debt to incomes that we're watching at all times. So you have your front end which is housing. Okay. It's going to include anything that we put in for the total house payment that is required by the loan to have in there. For example, if you have an HOA and that's required to be paid, then that's going to be taken into consideration in your front end housing. Okay, so the front end debt to income is how much is your housing payment versus what your income is. Okay. There are some rules of thumb. They're overlaid right now, but the higher the credit score, typically the more likely you are to get an approval with a higher front end housing ratio. Okay. Normally for conventional, you're almost going to be guaranteed approval with a front end at 31%. Now, I've had people at 29% not get conventional approval because their otherwise overall credit profile wasn't that great. Okay, they were at 29 but no reserves. So I can't say all of them, okay, but if you're running, you got a 700 FICO and like everything's good, right, and you're not getting approval, it's probably here. And a lot of times it's because you're like 37, 39, okay? And you're like, oh, I'm 39 on the back end. We'll talk about that in a minute. I'm 39 on the back end. I can't, why am I not getting? It's most likely this number here, okay? Now, what are the things that contribute to front end housing, okay? Your rate, taxes, insurance. If you have a second mortgage, and HOA. I'm gonna double check myself here and make sure I'm not missing anything else. Yep, and MIP. Okay, so if you're having an issue with a front end ratio, there are very few things that you can play with in order to get that front end ratio down. Okay, the first thing and the most effective is going to be the rate. Okay, if you've priced their loan, okay. If you don't understand what I'm about to say, I need you to go back and watch the video on borrower paid and lender paid financing because I don't have time to jump back into that today, okay? But you're gonna need to look at the pricing and see what the cost is for the next rate down. So sometimes what happens is we get so laser focused on finding the closest par rate or the rate without a charge that we don't realize the next rate down like costs 150 bucks, okay? But so you got to do that. Sometimes the next rate down costs like 2,000 bucks. That might not be doable. Okay. The next thing that you can adjust is homeowners insurance. Can they take a bigger deductible? Okay. Can we shop that around with another provider and get a lower premium? This video is going to be awesome on YouTube replay. It is going to be amazing. Okay. Now, this one, you got to move a lot of stuff around. You would have to move a lot of stuff around, okay? So the other things that you want, so this one, like if you're doing something that's 97%, what happens if we go to 95? Okay, because when we go to 95, then the pricing changes here. Okay, and the pricing changes here. Okay, but I don't know what another 2% is gonna be. Maybe 2% in the down payment is less than buying the rate down. Okay, the other thing is, remember, your rate is driven in buckets. Okay, if you're here and you're pricing, you're a 656, what is it going to take to get to the borrower to 660 so we can get repriced here for a lower rate? Okay. So you got to be creative and know what affects these items in order to get them to come down. These are the only ways. Well, so I guess the loan amount. Now, I will tell you that the majority of the time, lowering the loan amount is the least effective way to lower your front end debt to income. Okay, and here's why. This over here. Okay. On average, on average, every $10,000 in loan amount is only $55 a month. So then you start thinking, well, what is $2,500 if I buy the rate down? What does that change? And I'll bet you that
Your
that's
audio's cutting out, Jackie. Sorry.
probably because I'm a little bit further away. Okay.
Could you repeat that,
The
please?
reason that the loan amount is the least effective way to move the front end ratio is because every $10,000 in loan amount only equals about 55, 60 bucks a month. That's a lot of money to move that. So you might be better looking at, even if it means a couple $1,000s, how do I buy the rate down? It might mean if you're pricing this borrower paid, you might have, or lender paid, you might have to go borrower paid. Okay, this is set. We can't change this. This is set. We can't change this. Okay, this is basically set. Now, this would be a place where, okay, I'm probably going to get a bigger effect. Instead of taking $10,000 and paying down the first or whatever, what's 2%, right? Going 97 to 95. But this typically isn't going to help you very much. You're better off looking at what can we do to increase the score to the next pricing level, or how can we manipulate the rate? Buy it down, change lenders, whatnot here. Okay.
So Jackie, if you were to change it to borrower paid instead of lender paid, how would that work? How does that, or should I look back at one of the videos? Did you go through that in one of the videos? Maybe that I haven't seen.
I'll go through it really quick, but there is a whole video on it.
Okay, I'll look it up.
We'll go through it really quick. Okay. Okay, so rate sheets are just a scale. They go up and down, right? So let's say we have, if I'm facing this way, can you guys otherwise hear me relatively okay?
Sort of, kind of, no.
Yeah, you're a little bit too far.
Okay.
Yeah.
Like just a tiny bit too far.
Okay. Okay, now you guys are really close. Like,
That's way better. I can hear you better.
That's so much better.
I didn't shave my armpit, so it's making me a little nervous. Okay, so the first thing is the rate. We're looking for the rate. Okay, remember now, it's gonna have a number here. Let's say it's 3.5 and then 3. Oh, hold on a second. I don't want it matchy like that. Okay. So here's the rate. This is the YSP. This is the yield to premium or the credit for the rate. This would be borrower paid.
Sorry, repeat that last part.
Okay, this is the rate in purple. The yield spread premium is the credit for the rate or what the rate pays. So when I'm putting it in quotation marks, that's what you're going to hear people say. This is the credit for the rate or what the rate pays is the yield spread premium. When you're looking at your rate sheet, you're going to see this, and then you're going to see what the credit is. Now, let's say we have, and if you don't know what loan level price adjustments are, I can't jump into this too much, but let's say we have, we're a lender comp of 2.5. So lender paid or LP or LPC 2.5. And let's say we have 1 point in loan level price adjustments. Okay, a loan level price adjustment is an adjustment or charge for the characteristics of the loan, meaning what's the credit score? Okay, you're going to get a price adjustment for the credit score, right? So now you understand why I'm saying look at the credit score. If you're working with a 656 and at 660, the pricing adjustment changes for 660, that might be a better way to adjust getting a better rate. Okay, so it's a loan level price adjustment is going to be for FICO, the kind of loan program, the state you're in, your loan to value. I don't know if I said that twice already. What type of loan purchase, refi cash out, BA, FHA, right? So any characteristics of the loan is going to have a loan, is where you're going to see your loan level price adjustments. And then they're going to be added up and you're going to have a total at the bottom, okay? So our total adjustments, here is 3.5, okay? So a par rate is going to be the rate that covers our lender paid comp and the loan level price adjustment. So this is our par rate. Okay, now let's say we have too high of a housing ratio and we need to get a lower rate in order to make the deal work. Let's say we need this rate. Okay, what you see here is there is a deficit. There's only 3.25 credit and 3.5 charge, which means that the borrower is going to have to pay 0.25 difference. Okay, so on our example, so for every $100,000 of loan amount, in order to have this rate is going to be $250. So if you're doing $400,000 loan, that's going to cost $1,000. Now, let's say we need this rate to make it work, okay? So now the borrower is paying 50 basis points for to get this. So that's $500 for every 100,000. Let's say the borrower doesn't have that. Borrower doesn't have that, okay? So then what we're going to do is we're going to switch to borrower paid. When we go lender paid, okay, and we have our 3.5, in box A, you're only going to see, in box A, you're only going to see the difference as a charge between your total adjustments and your yield spread premium. So if you're quoting a rate of 3.75 for this scenario, 3.5 and 3.5, box A on your loan estimate or your CD is going to show 0. Okay, it's going to show 0. If you decide to go down, okay, then box A on your loan estimate is going to show a charge, discount, $100,000 loan, it's going to show $250 in box A. Okay, now, if you switch to borrower paid, this changes a little bit, okay? What you're going to see is in box J, which is lender credit, which is all the way to the bottom of page 2 of the loan estimate. And no, I think it's the bottom of page 1. No, bottom of page 2 on the loan estimate and CD. Okay. So what you're going to see, we have 1 point in loan level adjustment. So what you're actually going to see is whatever 2.0 is here as a credit in box A, and box A, you're going to see the full 2.5% charge, okay? So before you only saw the difference if it was lender paid, you only saw the difference. When you go borrower paid, you're going to see the full charge. Now, I have a 0.5 point difference here, right? We talked about that. We have a 0.5 point difference here, okay? My borrower doesn't have that money. So I'm going to reduce this, that boy, to this, and now it's capiche. But it's not that simple, and I'm not jumping into compliance. It's not that simple. We talked about it a lot more on the borrower paid, lender paid video. High level thinking here, very high level thinking, okay? So that would be the way you would go to lender paid to borrower paid though to get the rate, and you, my friend, as the loan originator, are paying that for your client. Make sure they know that, and make sure you expect them to send you all their friends and family, because you're contributing 50 basis points of your hard-earned money to get that rate for them because they don't have it. Okay. Okay, back end ratio. So back end, right? So the theory behind this is, if you're going to pay your bills, you're going to pay your house first. That's why it's in the front, okay? And then back end is whatever you're going to pay afterwards, okay? So what we consider on the back end is going to be any of the debts that report to credit or are court obligated to pay, like a wage garnishment for a bankruptcy, or a wage garnishment for a debt, or child support, or alimony, in addition to whatever comes over on the credit report. They're okay, they're fine. It's not really making that much noise, okay? So the back end is now going to include everything from the front, everything from the credit report, and anything that's court ordered. Child support and alimony, okay? Every loan product is going to have different back end ratios that it will approve. I'm going to teach you this the way things normally are. Please know that there are adjustments for COVID, and y'all need to spend some time learning what they are. Sometimes they're just Fannie restrictions, and the reason is because we didn't get a real clear bullet point of what exactly these are going to be. They kind of said, not kind of, the announcement came out and said, hey, we're going to look at the borrower profile as a whole, okay? Then there are some banks that are having their own overlays saying like, hey, I know Fannie will let us go to 45 on these bad boys, but we're going to stick at 43, okay? So Fannie will typically let all of your housing, your car, your credit cards, your student loans, your personal notes, all of that stuff, Fannie typically will let you go to 49.99. Except, and this is like the stupidest rule, seriously, like somebody patted themselves on the back for this and it's a joke. Except if you're doing cash out and you're above 45%, They want 6 months of reserves and you can't use the cash out that you're getting to count for the reserves. It's fucking stupid. Like, whatever. They didn't ask me. Okay, whatever. Okay, Freddie. Now, these are not their guidelines. I'm telling you based on real world experience, okay, what typically is approved. Freddie does not really like anything over 45, but if you have a 700 FICO and you're above 45, try it. Okay, oftentimes Freddie or LPA will like things that Fannie doesn't, and vice versa. A lot of times Fannie will like things that Freddie doesn't. And so sometimes what you see happen is if one of them starts taking market share, so Freddie Mac was the first one to come out with a 3% down program, conventional. Well, okay, listen, if you're over like 100 years old and back in the day when they used to do this, be quiet and sit in the back, okay? When they recently came out with Home Ready and Home Possible, Freddie Mac came out with it first, okay? And it was the conventional version. Like people with 700 credit scores were getting FHA loans because it was 3.5% down, okay? And all of a sudden FHA was taking up all of this purchase market share. And so Freddie was like, hey, FHA, y'all, like, I want some of that pie. So they're like, we're gonna do a 3% down conventional. Well, then Fannie was like, hey, wait a minute. Like now you're taking my FHA stuff and Freddie's getting all this market share. So then they replied and introduced Home Ready. Okay, so what you have here is healthy competition. And a lot of times this helps. So like, I don't think that Freddie restricted their guidelines as much as Fannie did in COVID. But Fannie typically has a bigger market share. So it would make sense that they would be more heavy-handed because they have more to lose if things get worse, right? So hopefully that all makes sense. But right, so you have, they often compete with each other. So that's why when you go to UWM, they have you run both. Because sometimes you'll get one in the other, or you'll get better terms on one, but not the other. Okay, so back end is gonna include all of this. Now, you have way more flexibility. So let's say your front end is fine at 29. And let's say your back end's 52, okay? Well, you can pay off anything that's on the credit report to bring this down. Let's say they got like, you don't even know how many times this happens. Somebody has a small Victoria's Secret credit card. They got 180 bucks charged on it. Okay, I'm someone. And my payment is $35 or $57, whatever it is. I mean, pay the $130 credit card off and eat up that $57, which is gonna, I mean, every loan's gonna be different, but that's what's gonna move the needle down below 50. So you have much more to work with trying to lower your back end that doesn't have anything to do with changing the terms of the loan. Okay. You can also on the back end, now the underwriting systems have picked this up and gotten a lot better with it. If you have an installment loan, so an installment loan, don't overthink it. You pay the thing in installments. It's the same payment every month, regardless of what the balance is. When you're done paying it off, it's closed, it's done. Cars are installment loans. Personal signature loans are installment loans, okay? Credit cards are not installment loans. But if you have less than a year, so you have less than 12 months, you can exclude that payment. That is true for all loans. However, FHA has a rule that says the payment can't be more than 5% of the income. Don't worry about that. Just remember, there's something tricky about doing it in FHA. You can go search the guidelines and remember, but you'll remember like, oh, I know I can do this, but there's something about FHA, right? I've been bitten in the butt by it. That's how I found out about it, because I tried to exclude a car payment. Car payment was like $300 and some odd. It was more than 5% of their income. And they're like, you can't exclude it. And I was pissed. Then there wasn't very much else we could pay off. So like I took a bath on that one. I think I made like 500 bucks because we had to buy the rate down and we had to get the deal done. And sometimes that's what you have to do. Okay. There's lots more you can play with on the borrower profile to get the back end down. Maybe you don't have any credit or anything that you can use to pay off. Okay, so then even though your front end is fine, you still might go to the front end and adjust the rate or see if you can get lower, because if this goes down to 28, that goes down to 51. Okay, so they move in tandem. The only time, or sorry, the front end moves in tandem with the back end. The back end does not move in tandem with the front end. The only time they're in tandem is if you're doing something to the front end, then the back end also changes. But if you do something to the back end, it doesn't change the front end. Okay. Any questions on this stuff?
I'm good.
We did a class, I don't remember if it was processing or loan officer assisting. And I was talking about this whole new like averaging income. I hate it to no end, because what effectively happens is if somebody gets a raise mid-year, and they want to give you the year-to-date average. So the simple math is somebody was making $10 an hour. They got a raise in June. It's now October. They got a raise in June to to $12 an hour. Your underwriter wants to take all the income year to date over 9 months. That's bullshit, because now you're basically taking the average and giving them like an effective income of $11 an hour, right? 10 plus 12 is 22, divided by 2 is 11. So what you have to do is you have to fight the underwriters and say, no, I want you to average his hours and give us our current rate of pay. Okay, this is a conservative approach. So if you're losing files or having files where you're arguing about income, this is why. Okay, so what you have to do is you have to go to the employer and get an hours report, or ask them, and this is usually really easy for them. It's something they can usually have access to really quickly, but you get an average hours report, and it shows that, like, if it shows that they always work, like the lowest amount of hours they ever worked was 38, okay, then you're arguing to the underwriter that 38 hours a week, okay, so 38 hours a week times 12 times 52 divided by 12 is, this is 1976. What they're going to want to give you is this. Okay. Now listen, I'm using really small numbers. Okay. 1976, and that, listen, if you are an originator in this, you've had deals fall apart for less than $100 a month. Okay. 1976, almost $2,000 a month, versus damn well near $1,800 a month. $200 a month is going to kill a lot of deals out there. Okay, so you have to know, if they're saying, oh, the year-to-date income is really low, there are a lot of things that you need to be looking at. Did they get a raise? Did they get a promotion, right? They got a promotion and that came with a pay raise. Did they take PT leave without pay, right? Maybe they they used their vacation earlier in the year, and then somebody got sick and they had to take a week off and they took it without pay. That would also have you, I mean, we're dealing with this a file right now where the approval came back and she's like, year to date was really low for 32 hours. And I'm like, 32 hours, the VOE says 40 hours. She's like, yeah, but his last paycheck had 38. It's like, yeah, his last paycheck has 38. Why are you giving him 32? Like, what's going on here, right? So because they're taking the year-to-date average over the number of months and then backing it out, and it's getting all, but like, it's the easiest and most conservative way. And if left up to a bank, they're going to go conservative. Okay, you just have to know how to combat this.
So I have a question with that. So there's two different ways that people are doing math. Does it matter which method is used, or is one used more often?
Yes.
Because that, I mean, what's your argument? What's your leverage behind your argument?
The guidelines. So what's going to happen is as a loan officer, you're going to look at the pay stubs and see that they make $12 an hour and that they work 40 hours a week. You've got 1, maybe 2 months of pay stubs, and you see that on those 2 pay stubs, they make $12 an hour. Okay, a lot of times what happens is underwriters use either Uber Underwriter or their own system calculated income worksheet. And so they're going to put it in $12 an hour times 40 hours a week. They're going to put in the year-to-date average, and then they're going to put in last year's, and they're going to do, right? And so it comes up with 5 different answers based on year-to-date average, hourly, current year-to-date, and previous year-to-date, and it'll go back up to 3 years, okay? And they have some methodology there that says, basically, if your hourly rate times the current hours is more than your year-to-date average, you're going to use the year-to-date average, okay? But my issue with that is if they haven't been working the whole year at their current rate of pay, we are not giving them credit for their effective pay because they earned income part of the year at this and part of the year of this, okay? It's a conservative approach. So if you need every penny of this, you've got to go back and do the work and say, hey, I want you to average the number of hours. So like, I'm fine with the average, but I need you to average the hours multiplied by his current rate of pay, because this is not flexible. This is not the variable part. The hours are the variable part. Okay, but a lot of times in the forms that we request don't give us that information. So they're capped in what they can do based on the information we give them, which is based on, now to a degree that is true, because usually paycheck stubs show what their year-to-date hours are. Okay, but in some instances they don't. They just tell you what the hours were for this pay period and what their year-to-date earnings income are. But you absolutely can argue, because they're going to say, oh, well, it's average income. That's fine, but you're not going to average the dollar amount he's paid. You can average the hours and then give him, I always say him, it's just general. You're going to give them their current rate of pay, because this is not what's flexible, the hours are. So effectively, if you let an underwriter just give you the year-to-date average, you're letting them give you a subjective hourly amount, because they didn't earn this the whole year. Does that make sense? So you're still,
Yeah, and then would you do,
you're still honoring the guideline of variable income. The thing that you're telling them is this isn't what's variable. The number of hours they work is variable. So you're
That's
gonna average the year-to-date, yes. So you're gonna average, but they don't do that. I can't speak to why they don't, because I'm not an underwriter, but I get this overturned every time. Now listen, if the loan works with the way they did it, pick your battles and move on. You're gonna have bigger fires to put out. If it works with the year-to-date average, so be it, let it go, okay? The borrower's probably gonna throw a fit and be like, oh my God, I make more than that. And you just say like, yeah, you know, a conservative approach sometimes they do is take the year-to-date. They do know that you got a raise and this is gonna come in lower, but it still works. And so we're just gonna pick our battles, and it's of the things that we have going on right now, it's the least of importance, or just explain to them how they got that. But this isn't what's variable. The hours are variable. Okay, so don't lose a deal for this. Amy, did you have a question? I feel like you were starting to say something.
I was just going to say, would this be like a letter of explanation, or
No.
would they be looking for something specific on the verification of employment to show when they got a raise, or, you know, does that help your argument, or do you need it?
So it doesn't really work like that. So what's going to happen is a loan's going to be submitted with the current rate of pay times the hours. you're going to get a loan back and it's either going to be suspended or it's going to say, hey, we need a letter of explanation. It might be a letter of explanation of why the year-to-date income is lower than expected or lower than you calculated, right? So there's going to be some sort of notification on the approval that the income that you submitted with and the income the underwriter is using is different, significantly different. And more times than not, it's going to impact your transaction. It's going to bump your front end or it's going to bump your back end way out of whack. And you might, depending on the lender, like some places like to hand out suspenses, like my mom on Halloween, okay? She liked to give the big candy bars. Other places, they trick you a little bit. They keep it approved, but they have this like critical condition, we had an issue with the income, okay? So it's not really, now, the more seasoned you get, one of the things that you might ask them is, have you had any change in your pay this year? Okay, it gets a little bit confusing because I would say if you're processing or you're originating and you are maxing out that income, good question to ask. If you're sitting at like $29.35, probably don't worry about it. If it rears its ugly head, then you can deal with it. But if you're maxing that stuff out, and this is why like people who, my staff that works in here with me, like if I'm maxing something out using overtime bonus and whatever, I don't submit that file until I have the VOE, even if it's not an FHA deal, because it's too volatile. It's too volatile.
Yeah. Yep.
So,
Gotcha.
okay. All right. So income. Oh, y'all. Self-employed income. Like, I hate myself as a borrower. Like, I hate myself as a borrower. Okay. Self-employed income comes in so many ways. So many ways. Okay. So I'm going to do my best to go over some of these ways, but let me do this really quick. I put it in the link the other day, but let me drop it in here again. And it is an income calculation worksheet. The reason that I love this sheet is because when I try to use the Fannie Mae form, it doesn't do the math for me. And because I'm not an accountant, and because I don't do these forms and they read accountant language, which is not a language that I subscribe to, right? It'd be like somebody trying to come in and do something in our language, right? And they're like, I have no, well, so for example, somebody's daughter came into the class yesterday because she thinks she wants to learn how to do this, which is freaking awesome, right? But she's like, she has no idea what you said. And I was like, well, yes, because you hopped in at class 7. You're not going to come into Spanish class in high school in halfway through the first semester and think that you have any idea what anybody's talking about. Okay. So that being said, that's the same for me. Like, I don't speak accountant. I don't speak accountant. Like my husband and I, like he does a lot of my accounting and he says shit to me and I'm like, don't talk to me like that. I have no idea what you're saying. And he's like, oh, but you carry over the balance and the this and the that and accounts receivables and payables and blah, blah, and you move it over here and I'm under the income statement. And I'm like, stop talking to me like that. You're making me mad. I don't know what you're saying. Okay, so here we go. So an S corp, so anytime somebody is self-employed, the way they designate themselves,
Your audio.
I'm right next to my machine. I'm like right hugging it. Like you can smell my armpit.
That's better.
Okay. So an S, how a company is formed dictates how they are taxed. Okay. I'm gonna tell you how I'm set up here. Okay. So next generation home loans is an S corp. So when we close loans, all the money comes into here. Okay. Then we have a bunch of expenses, credit reports, office, insurance, all that stuff. Okay. don't come at me about compliance on this, or I'm kicking you out of this class. Okay. I pay myself as an originator as an LLC. Okay. So this company pays compensations out. I have a limited liability company for my originations. Okay. This can be set up as a partnership or a sole member LLC. And the reason that it's important is because if you're self-employed and you have more than 25% ownership, it dictates what tax returns you're going to need. Okay. So S Corp income is given usually on K1s. Don't ask me what that means. I'm not an accountant. I just know it's called a K1. Okay. They determine based on how they're set up, how they pay themselves. My husband always says shit to me like an owner's draw and an owner's this and shares and whatever. I don't speak that language. Okay. But if you have more than 25% ownership, you're going to need the K1. Okay. Now, for an LLC, you're going to need an 1120 or an 1120S. Okay. That's if somebody's running as an LLC. They have an EIN number. Okay. A lot of times what happens is people who have employees typically end up going this route here for the liability protection. Sometimes single operators, meaning I was a painter, I worked for a painting company, I think it's crap because I don't make enough money and now I'm going to go out on my own. They will claim this income under their social security number in their Schedule C on their taxes. Okay. I will tell you that this, if somebody is self-employed in their Schedule C, meaning that they're claiming it, okay. Let me say this and then I'm going to come back to this up here. So somebody who only does their self-employed on Schedule C, you're going to have some issues. The biggest issue is proving proof of continuity that they've been doing it for 2 years. Because typically, Schedule C, they don't have to register with anybody. They don't register for the state. They don't register for a business license, right? Some of the things that you might be able to do on a Schedule C self-employed is ask them if they carry any liability insurance. Okay, ask them if they carry any general liability insurance. So a lot of times what happens is in order for them to get jobs on bigger projects, they have to carry a liability insurance and they have to list the property or the business that they're working for as an additional insured. So what other things that might be tied to their business can you get a history on showing? If they're a painter, can you have somebody at Sherwin-Williams show that that paint account was opened more than 2 years ago? Because a lot of times they'll say account established in 2010. Okay, so the biggest issue you're going to have with Schedule C is that you're not going to be able to provide proof in the most common ways. So you got to think outside the box. Is their cell phone registered in their business name? Because chances are they want to be able to write that off, so they put it in their business name, right? So then you could go to the cell phone store or have them go to the cell phone store and say, hey, can I get something, or where can I go in my account that shows when I open this account in the business name? Okay, it's a little sketch, but I would fight that every day. Okay. Sometimes people think that if they put certain aspects of their business in the business name, or some people think that if they use certain aspects of their non-business expenses in their business name that they can write it off. If they ever get audited, they're screwed. But for example, somebody might put their internet in a business name, right? Everybody in the house uses it, but they're gonna put it in the business name so they can write it off as an expense on their Schedule C. So can I get the internet provider to provide me something saying that this account was established in the company name on X date? Okay, we get the point of that here. Okay, so Schedule C is going to be inside of a person's personal tax return. Schedule E is going to be rental income or property income. If somebody fix and flips like we do, we have income in Schedule E. If you have rental income, it's gonna be in Schedule E. Okay. Now, I think it's Schedule A, where the LLC income gets put into the 1040. I could be wrong here. But just know if you have, you need to find out, did they file an 1120 or an 1120S, or did they just file it under their social security number on their personal tax return? Like now, hold on, I know where mine are, hold on. Okay, my personal 2016 taxes. So we had some W-2 income on line 7. So we have W-2 income. So W-2 income on line 7. And then on line 17, we had rental and real estate income. So if somebody's self-employed income is rental and real estate, then you're going to be in Schedule C. Schedule E, sorry. Now, when we first started, we did not file. When we first started doing this, we filed all of my origination underneath my social security number, okay? So what happened is my accountant took my original income, said, no, we're putting that in an LLC, okay? And we zeroed it out from my personal tax return. I'm not an accountant. I'm not telling you why. You wanna know why? You talk to your accountant. Okay, so 1120 income is not gonna show on a personal tax return. That's why you need 1120 income, because that's going to show the income of the business. So I did have that wrong. Now, as far as talking about what can be added in, listen, it's prescribed by Fannie and Freddie about what can be added back in. Meals, it so sucks. But like meals and entertainment cannot be added in back in because it's a tangible expense. Because it's a tangible expense, cannot be added back in. And that's going to be one of the things that kills your deal, because we do that to reduce the tax, right? But then we don't add that back in as actual income. So a lot of times people lose a lot with that. Now, the best kind of rule of thumb in what can be added back in typically is non-tangible expenses. So if you so for example, I prepaid my website and email addresses. I prepaid my website for 10 years and my email addresses for 3 years. If I paid that expense this year, 9 years of my website is a non-tangible expense and I can add that back into my income. If I depreciate the value of my tangible assets, that typically can be added back in. If I write off a portion of my home as an expense, I can add that back into my income. If mileage can be added back into income. Now listen, I'm not an expert in this. I just follow the rules, okay? So in the spreadsheet that I just linked over here, I'm gonna pull it up really quick. It's not open, so give me just a second. I'm gonna screen share with you guys. Okay, so this is the one that I use. I have actually used this for years. I've actually had this so long that you can see that it says 2016 at the top, and I have to go in and actually manually update these like every year. Okay, that's how valid this sheet is that I put in the links for you guys. Now, what you notice down here at the bottom is all the different tabs. Okay, so if you're doing a VA loan and you need to calculate residual income. Now, the only thing this doesn't do is it doesn't carry through to the different tabs, which is kind of a bummer, but so be it, okay? So if you want to calculate Schedule C income, okay? Sole proprietor, Schedule C, you come in here, and the reason that I like this is it tells you what line on the tax return to enter this data from. Okay, so year 1, year 2, here's our net income from year over year. This is our monthly income, and this is our 24-month average. Why would that be different? Oh, monthly income for the year, sorry. So that's this number, total income for the year broken out of over the month for that year. This one's income broken out over month of the year, and then this is your 2 years averaged into 1 month. Okay, this is why I use this one. There's Schedule F. Nobody should be using this. Here's your K1. So like I've been saying to you guys, like you don't have to know all the things. Like listen, I've been doing this 13 years and I'm like, I don't really know, right? Because it's not about knowing those things. It's about knowing how they pertain to the process of getting a loan closed. Okay, and so this, listen, I'm gonna stop sharing. I use that income spreadsheet and I send it to other lenders. And I don't care that it says Homebridge at the top. Okay, because if they can see how I got the income and then they put it in and then they're like, oh, cool. I'll tell you, I have far less problems on files when I turn that in with it than when I put it in, I manually calculated, think I'm all right, and hope for the best. Okay. It's 11:25. What questions can I answer for you guys based on the stuff we went over today? And I think we'll probably end early. Well, I have something to share with you, but Jessica Faye, I'm looking at you, kid.
When you were talking back end ratio and front end ratio, and you were saying, you know, the 28-52 or 29-52, 28-51. I don't recall if you had mentioned anything about it, but is there a certain ratio front end to back end that we're trying to stay within, or is it just falling within the guidelines of back end and guidelines of front end?
Yeah, I mean, so, you know, conventional is always going to be the most restrictive. Yeah. So conventional Fannie, like 99.9, like ever, 100%, you're not getting approved on a back end above $49.99.
Right.
Okay. Freddie, I mean, I can't tell you the last time I got I can't even tell you the last time I saw an approval above 45, but I would say 49.5. Now, I say 0.5 because Freddie rounds up. So if you're at 49.5, it's going to round up to 50 and you're going to lose it. Okay. FHA, I mean, this is going to vary a lot, but if you're above like a 620, most of the time you can go up to 56.89 on the back end. Okay, and you can get really high on this front end depending on the borrower profile. So it's not really prescribed except for the like, you can't go over 50 and you can't go over 56.89. Why it's 89, I don't have any idea. It might be 86. I don't really know. I don't remember because I don't ever go that high. Like once or twice a year I go that high, but it's typically because we have a spouse that's not on the loan because their credit profile is worse. So like I don't have any problems going up this high because I know that there's a second income in the house. It's just not on the loan application, right? Front end on conventional, once you hit 35 on the front end, it's going to be real sensitive, real sensitive. Now, have I seen stuff go up? Yeah, I've seen stuff go way up. It's going to depend on reserves, like how much money do they have in the bank, but above 35, she gets real judgy. She gets real judgy, okay?
So if we were at 35 on the front end, considering that's your housing, your HOA, and your mortgage, well, a couple classes ago, you were talking about if there was minimal change in housing payment from previous mortgage to the one that they're applying for, would that be something that we could apply to this, or is that completely different?
No. So on conventional, you have to, the biggest key on conventional is to have your approved eligible findings, okay? Most of the lenders are going to defer to whatever your automated underwrite. So this is approve eligible or approve accept. This is LPA, this is DU, right? So when I'm saying like I've seen approval, I've seen, what I'm saying is that when I run DU or LPA, as long as I maintain my approve eligible or approve accept, then we're good. Okay. What you're talking about is a compensating factor for FHA.
Oh, okay.
Okay. So that is going, so FHA is where you can do a refer eligible. Okay. And you can do refer eligible most of the times when you're running FHA and you get a refer, it's because you're a lower FICO, like under 600 or under 620, and you're pushing over 3143. Okay. So if you're under like a 600, and now these are just generalizations. Okay. But if you're hovering 600 or lower and your ratios are 3143 and you get a refer above 3143, let's say you're 3145, okay, you have to have one of the compensating factors as prescribed by FHA, and there's 5. Only 5. And they're very cut and dry. So that being said, one of the easiest, one of the very easiest, and if you need a compensating factor, you need to submit this with your initial submission. You go to the residual income chart, you complete this. This is the VA residual income. If you're doing a VA loan, you need to make sure you do this as well. Okay, because they can otherwise qualify, have all the right ratios, and if they don't have residual income, you're not gonna get the loan approved, and then you gotta start making adjustments. Okay, so what they want is, this is a form that says, here's your loan amount, here's your income, monthly taxes, monthly housing expenses. Now, one thing that they put in here that we don't take into consideration on the loan is utilities and maintenance, and it's the prescribed equation for it is in this form. Okay, auto loans, credit cards, installment loans, these would be like student loans, personal loans, and child care. That's something we also don't consider in other loans. Okay, and then they also, in income up here, you actually have to basically like either manually calculate or take 1 month of pay stub, see what they have deducted for federal, state, Social Security, and other taxes. Okay. Now, as long as this number down at the bottom meets
the income requirements. So let me scroll over a little bit. So for example, we're in Colorado, which is considered, I believe, Midwest, and we have a family size of 4, then we need, at the end of this table, we need this number to be 1,033 or 1,003 or higher. If it's 1,003 or higher, we've met the residual income requirement, and that is the compensating factor for FHA. And it doesn't require anything other than your time to complete this form. It is the first thing that you should do if you need a compensating factor on an FHA loan. It is the easiest, it's a slam dunk, okay? So that compensating factor is only on an FHA loan. Now, I've had loans, especially self-employed, where they put a cap at 43 and we're at 45. I have gone to lenders and said, hey, we have 2 FHA compensating factors. We meet residual income and the current payment is less than 5% more than the current payment. Would you request an exception for me to go up to 45 on this deal? Okay, I can't just say like, we need 45. I need you to get that for me. Give your account executive ammunition. Give them to the FHA compensating factors. It's not subjective. It's not opinion. It's FHA's rules, not mine. They said they'll let us go higher DTI if we have a compensating factor. I've got 2, and I'm only asking for the leeway that's required for 1 on an FHA deal. Now, especially if it's a lender overlay. If it's a lender overlay. If it's a product guideline, no chance in hell. Okay, there might be places. Now listen, I know this is going to go on YouTube, and if anybody from UWM sees it, they're going to hate me. But probably not going to get that exception at UWM. Okay, they just don't really make exceptions for things, but it's worth the ask. Okay, if you have to have it, you might have to move the deal, but like, isn't that why we're all brokers? Because we were all limited by not having the option of being able to move loans. We just had to say no. Okay, that's what's going to make you different, and that's how you think outside the box. Like if it's a lender overlay, like right now, lenders have overlays, they're only going to 43. That's not the guideline. That's their rule on top of it. So put together your compensating factors. If they've got 3 months of reserves, that's an FHA overlay or FHA compensating factor. Go back to them and say, hey, I've got 2 FHA comp factors. I meat residual income, and I've got 3 months of reserves. Can I get an exception for this to be 45 instead of 43? Okay, but don't leave it up to your account executive to figure out what the bullets for the ammunition are going to be. This is why I get a lot of tough deals done, because I know my stuff, and I know how to give my account executives the goods to go and fight for me and fight for my files. And I will tell you, 9 times out of 10, Remen is the one that does it. I've had Remen close, y'all. I've had Remen close on an open Cavers and hold my file because I provided them proof that my borrower in fact made their final payment in their student loan repayment plan, and they held that file before sending it to FHA, and they closed this on an open Cavers. Now, I still had work that I had to do after funding. Like I had to basically promise and give them like first rights of refusal to one of my children, but that we got the loan done and it made sense, and we provided the proof, and we had the compensating factors, and we got the deal done. Okay, for you as a processor, if you're getting a refer, get that VA that VA residual income sheet filled out. It's the easiest thing. Like it's the easiest thing. And it is one of those things, I said this yesterday in the processing class, I freaking hate doing it. I freaking hate it. It's why I have a processor. I'm like, hey, will you fill out this form? Thanks. Because I hate it. Any other questions? Like I really want to hear from Jessica. I just want to make sure, because it sounded like you had a question yesterday. Or Nate, if Nate signed in as Jessica. She's probably yelling at her kids. Okay, any other questions about any of this that we went over?
How common is it to like not have county limits? Is that even a thing that really needs to be worried about a lot?
I think for an originator, you only get burned by that once and learn it real quick. So otherwise, what'll happen is when you run underwriting, you'll get like approved ineligible, and it'll say to you that it's ineligible because the loan amount is higher than the county limit.
Okay,
So
so
it's
you'll
not
find
like
that in
you-
DU.
Yeah, so it's not like you would get too far into it and know, but HUD is catching up. Like they're catching up on their, so like 2020, I think they increased, and a lot of those counties with the lower, maximum loan amounts really went up and caught up, but you would find it before you submitted because you would see this would turn to an ineligible instead of eligible.
Okay,
Okay.
perfect.
And that's the other thing is in your findings, if you got something wonky, okay, this is going to say AI, ineligible, but your findings are going to tell you why it's ineligible. Another little secret is if you're doing an FHA loan and you don't enter the payoff and you don't enter the fees, you're going to go down this really fun spiral with DU where it's always going to tell you that the loan amount that you put in, it's ineligible because the loan amount is too high for what it calculated, and it's because you don't have the prepaids, the closing costs, and the payoff in. So I learned this the hard way just this last year because it was something that changed. And so you got to make sure that when you're running FHA refis, simple refis, that you are putting in the payoff, the actual payoff amount, not just what's on credit. Now listen, if you don't have a payoff, okay, let's talk about this really quick because this is really important. If you're doing a refi, people get pissed about this. Okay, if you're doing a refi and you're trying to determine the loan amount and you just use the balance that's listed on credit, you're going to screw the pooch. Because oh, you may not know this because I didn't know this for a long time. I didn't know this for a really long time. Okay. Mortgage interest is paid in arrears. Okay, it has to be earned before it can be collected. What the hell did I just say? Okay, what I said was it's not like your cell phone bill. Your cell phone bill you have to pay to use it, which means I pay $100 in April 1st, which typically only covers me until April 10th. And then they're going to want to bill me again April 10th to use it till June 10th. Okay. Now, mortgage interest has to be earned before it can be collected, which means when you make a payment June 1, this payment is for the month behind. This is actually for May. Okay, because all the days of May passed and the June 1st payment is the collection of all the days of interest that were earned for May. Okay, so if on your credit report, it says the balance of your loan is $100,000 and the last date of last activity was April 20, like as in 2020, okay? And the payment is $1,000, okay? Well, that means that April was actually March's payment. So what I do is I take the balance on credit and I add 1 month of payment and that's what I tell DU is the payoff amount. And I update this, let me show you. Okay, so I'm in Calyx. It doesn't matter what platform you're in. You're going to go to liabilities. Okay, here's my mortgage. Let's say my payment was $1,500. Okay, and if I'm doing a refinance, then I'm going to say that it's going to be paid off. And I'm actually going to add 1 month's payment here. So I'm effectively telling DU and Fannie, and then when I go to my forms, I go to loan estimate and I do payoff and adjustments, when I copy from the liabilities, it pulls up the payoff that I entered in there. Okay, if you don't do this, your loan amount's going to be short. So if you're doing refis and you're constantly coming up with not enough loan and people are bringing money in, it's because you didn't take into account that mortgage is paid in arrears. So if I close June 28th and the June payment wasn't made, I need 28 days of interest for the payoff. And at closing, I need 2 days of interest because we're closing in June, right? Because there won't be, this is why people don't have a payment the very next month after they close a loan. So then there would be no payment for July, and then August 1 would be my first payment because August covers July. We closed in June and we collected the 28 days on the payoff because that went to the mortgage company. The 2 days at closing is for our current mortgage. No payment in July because we already paid June. August 1 payment covers days of July. Hopefully you guys can see all that. So the best way to make sure that you're structuring the deal to where you're not like, and listen, if it happens, you just say, oh, well, the payoff we need you to bring the June payment to closing. Or this is the money for your new escrow account. Okay, but hopefully this makes sense. The easiest way to do that is explain to the borrower. They're like, but I already made my April payment. Yes, I understand that. Mortgage payments are actually paid in arrears. You have to use the loan before they collect payment on it. So your April 1st payment covered the month of March. We have to collect the days of interest for April. So I just typically add 1 month of your payment to the balance to make sure that we're not surprised by anything. And they're like, oh, okay, that makes sense. And then I explained to them, that's why you won't have a payment until August 1st, because we're closing in June. So we're already collecting the days of interest. Your August 1st payment will actually cover the month of July. Okay. Any other questions?
Yes, I do. So the 2 days of interest then will be added to the August 1st payment.
Say that again?
The 2 days of interest you said at,
no, this is going to be collected as cash to close.
Oh.
When you see days of interest on the loan estimate or the closing disclosure, they're collecting the days of interest that close out the current month that you're in.
Okay, so that actually answers another question I had. So the term cash to close is what you're bringing for those days of interest left over?
So cash to close literally means anything that's not covered with the amount of loan that you're borrowing. And it literally is the money you need to be to closing. Now, this is one of the items that's included in the calculation to figure out how much cash to close you need.
So cash to close can refer to the leftover interest that we're paying on top of other things? Or is it just referring to that interest? Or am I completely confused?
Sort of. So cash to close. Okay. Doing loans is just debits and credits. So for example, if you're buying a house at 200
I can't hear you. I'm sorry. Can you come closer, please?
Yeah, I can't. It's as close as it'll go.
Oh, that's much
If
better.
it's just debits and credits. So if you're buying a house that's 200, okay, and you've got to have a 5% down payment. So this is your money. So that would go in the cash to close. And you're going to get a loan amount for $195. Okay. Then you have title work. Let's say title work is $1,000. That goes cash to close. Taxes, we're collecting for escrow, that's 3 months. So let's say that 3 months is 300, that's cash to close. Insurance, if it's a purchase, you gotta collect 12 months plus 3 months for escrow, that's cash to close. The days of interest for the month you're in. So in our example, it was 2 days. That's cash to close. Your underwriting fee, processing fee. Okay, that's all cash to close. Okay, this is offset by any credits. Okay, so this particular example is a purchase. So you might have a seller credit of $1,500. Okay, so that is going to reduce the cash to close. I may have a credit from the rate, which is going to reduce my cash to close on a purchase. Also on purchases, you're going to get a credit not HOA. You're going to get a credit for the property taxes. So if you buy a property in June and you live in a state, which I think most are, where taxes are billed in arrears, same thing as mortgage, right? Property taxes billed in January 2020, that bill for January 2020 is for the taxes for the year behind you in 2019. So if you're buying this house in June of 2020, the seller is going to give you a credit for the amount of property taxes prorated from January to the day of closing. And that's going to be here. And that's also going to be a credit, right? Because we had to collect for taxes here. And you're going to get a credit from the seller for the 5.5 months that they own the property in 2020, because in 2021, the bill is for all of the months for 2020. So you're going to get a credit at closing for the number of months and prorated days that the seller owned the property for 2020. And that would reduce, all of these would reduce cash to close. So cash to close is not tied to one item. It is representative of the transaction, and it is the deficit of the charges versus the credits. And the loan amount would be a credit, right? So $200,000 is the charge. They get a credit for the loan amount of $195, and then charges all along the way. Now, charges is used loosely because insurance and taxes are the borrower's own money that we are collecting at closing, and we're going to hold on to that for them to pay their taxes and insurance. That's a prepaid.
So prepaid always refers to the taxes and insurance.
Yes, and days of interest is also prepaid, I believe. I have to
Thank
double
you
check.
so much.
Yep. Claudia, what were you going to say? Your mic came on, but then I didn't hear
I
anything.
just wanted to ask if on a refi, cash to close, would that include the payoff?
Yeah.
Basically, okay.
Yeah. Okay, so let's do this for a refi real quick. Okay, so if we're a refi, let's say the payoff is 125,000. Okay, that's the charge. Let's say our new loan is 127,500. Okay, that's our credit. We're gonna pay off the old loan. We have 2 days of interest. We have the new escrow account or prepaids. We have the underwriting fee. We have an appraisal maybe. Well, I'm not gonna put that. So we pay for a lot of appraisals at our company and then get reimbursed at closing. So that might not be a good one. You have your title fees to close. Okay. So if all of these add up to more than our new loan amount, so let's say this will add up to 128. Okay, so our payoff was 125. Our new loan amount is 127.5. So payoff, days of interest, escrow, underwriting fee, title fees. Let's say that was 128. Then the borrower's cash to close is $500. They have to pay the difference between the charges and the new loan amount. Now let's say all of that was only 127. Then on funding, the borrower would get 500. They would have no cash to close. They would be getting a refund or a surplus of the $500 difference because our new loan amount was 127, all the 127.5, all the charges were only 127, which means there was $500 left over. So the borrower would be getting that back on funding and there would be no cash to close.
Awesome. Okay, thanks.
Does that help, Claudia?
Yes, and then they might get a credit if they've paid into the interest and the taxes and the insurance. They might get a check later, right? On a refi, if they have money in escrow.
Yes, so that's a little bit separate. Like if the payoff didn't net the escrows, then when this is paid off, the account is closed and whatever money is in the escrows would be returned back to them. So one of the things that you want to talk about with them, right? And this is what I tell my clients, Jamie and Isabel have heard me say this a ton, which is it's a little bit like monopoly money. And a lot of times one hand washes the other. So if your client is trying to do a rate and term refinance and they could use a little bit of money out, but we can't really squeak out money because it's going to flip us to a cash out or there's just not money built into the loan to value, right? Like we can't get out because we're refining a rate and term at 78%, right? So you can't get cash out, okay? One of the things that you can do is tell them, hey, we're going to collect money to establish the new escrow account. Once we refinance this and pay it off, then if you look at your mortgage statement and see what's in the balance on the escrow account for your current mortgage company, that's going to come back to you. Okay, some people don't want to do that. So what you can do is order this payoff and you have to like call and talk to somebody and you can say, I want you to net the escrows, which means they're going to take the payoff and they're going to, let's say they have $1,000 in their escrow account for taxes and insurance. You want them to apply that to the balance, which effectively makes this 124, which could change this. Okay. But a lot of times people have, it depends on what time of year it is, will depend on when they can get that money out. And so effectively they're financing in the new loan amount, their new escrow account. And it's just a way to squeak out a little bit of money for them, which is probably a good thing right now, is to squeak a little bit of money out for people. So we typically don't net escrows, like almost hardly ever. And then you can structure it to where, if somebody says, I don't want to finance my escrow account in there, then what you do is you reduce the loan amount to where the cash to close equals the prepaids, So then they bring the $1,000 to closing, and they know they're getting that $1,000 from their escrow account back in when we say 7 to 10 days, some companies hold it a little bit longer, but it's typically within that 10 days they get this back. That was real quick math, but does that make sense too?
Yes, it makes great sense. Thank you.
Okay. Yeah. So, a great way to help people get, you guys, since 2012, December has been my busiest month of the year. We close a tremendous amount of loans in December, and here's why. Since 2012, December, where there's effectively only 3 working weeks in the whole entire month, because everybody takes from Christmas to New Year's off, okay? So we do so much business in December because if you close in December, okay, the payoff includes fucking how to spell today. Includes. Okay, if you're new in here, this is my fine point disclaimer. I forget to point that out until I realize I've said the F word 5 times. So sorry. Okay. So the payoff includes December's payment already. Okay. So as long as anytime the November payment is made, after the November payment is made, the payoff that you order includes the December payment. Because payments are made in arrears. So if we close in December, the payoff already includes the December 1 payment, and let's say we're closing on December 10th, okay? And it includes 10 days of interest because we're closing on the 10th. We're funding on the 10th, okay? So if we fund on the 10th, the payoff includes the December 1st payment and 10 days of interest. When we're doing the new loan that closes in December, because we're funding on the 10th, our new loan includes 20 days of interest for December. That is charged on the new loan. So when's the client's first payment? No payment the month of Christmas. No payment the month after Christmas. Payment February 1. And if I don't net the escrows, right around Christmas, they're getting the escrow check back. Now listen, I learned a really valuable lesson. How long ago was that with JK and Elena? 3 years ago? 3 years ago, okay? I'm gonna share this with you, and then this is the last thing. 3 years ago, I had a client reach out to me. It was December, wanted to do a refinance. I was super excited. It was a nice chunk of change for me in December. I was super excited. Did all the work, structured the deal. And I was like, man. Called him up. I said, hey man, I don't know if it's worth it. I'm only saving you it was either 57 or 75. I want to say it was $75 a month. So we didn't even break $100 a month savings. And I said, I'm not sure it's a good deal for you. And he was like, wait a minute. You're telling me I can miss my December payment, my January payment, and save $75 a month? Let's do it. And in that point, I realized I cannot subject, so long as I meet all the criteria, I meet all the compliance, I cannot subject my perception of value, what I perceive to be valuable, onto my clients. And so now when people ask me things like, well, do you think it's worth it? I say to them, my value perception is uniquely mine and yours is uniquely yours. And I have 6 kids plus a bonus child. What I find of value is not even going to be in the realm of the majority of the people in this room. Because the majority of the people in this room, and I do have some family members in here, but the majority of these people in this room have no idea what it costs to run a family of 9. So you can't prejudge. So as long as you're meeting the net tangible benefits to do the loan, you're providing a value, you're satisfying the client's need. Don't say to somebody, it's not worth it. I don't know what they were going through. I have a veteran right now that is trying to do Dave Ramsey. We weren't saving them a terrible lot of money on their refinance, but we met the tangible benefit as required by VA for an IRRRL. And the reason it wasn't a big dollar amount is because the loan amount was low and the interest rate was low. But she said, if I don't have to make my 2 payments of $1,000 a month, I can pay off 4 of my credit cards. And if I pay off those 4 credit cards, I'm actually saving $120 there. And the $65 a month or $76 a month you're saving on my mortgage, I'm actually saving $200 a month. If I take that $200 a month and just re-back it into my mortgage, and we put them in a 20-year, we took them out of a 30-year, put them in a 20-year, they were still saving $76. And by her paying off those 4 cards and taking that money and applying it to their mortgage, they effectively put themselves in a 10-year mortgage note. But had somebody just looked at it and been like, oh, we're only saving you $76 and didn't understand their motivation or what they were trying to accomplish, my client that I was just telling you about, they knew that they were going to be moving in a year. So it was more important, and they had a bunch of equity because we did an appraisal, so they knew, right? So for them to have that immediate savings for whatever it was that they needed was more important than not saving the $76. Now, I have another client, I don't understand this. I do not understand this thought process, but her thought process is it's not worth it for her to spend $1,500 between title fees and an underwriting fee to save $200 a month. That is her value. That is her value perception. I, on the other hand, am like, I think you're bonkers. I think you're completely crazy. Because what if you took that $200 a month and applied it to a vehicle you own or applied it to a credit card? How soon can you pay some of that stuff off, right? So I just want to urge you, like, don't put what you perceive to be a value into your clients as long as you're meeting the net tangible benefit requirements.
Wouldn't that also include, for that first example, also the second, improve her FICO score by paying off those credit cards? Wouldn't that also improve her credit score?
It would, but it wouldn't matter because she had no intention of obtaining any other financing. Because she would be paying those off after we did the loan, it really wouldn't have had an impact in that place.
Well, unless she's building up a time schedule for something 3 years, 5 years, maybe. Could it be looked at like that,
So,
or am I overthinking it?
No, it's because their particular situation is they were trying to debt snowball and pay things off. Their intention isn't to finance anything. Now, what it could do is if they had a vehicle, which I don't remember if they did or not, but in the example that you're saying, they could then get the new loan, pay off their credit cards, raise their score, and refinance the vehicles at a lower rate, which then effectively would give them more savings, right? So really taking the position as a full, like for me and why I'm referred so wildly, like I don't spend money in advertising, is because I look at it like a family approach. Like I see what's going in and out, y'all. Like I see what you make and I see what, like, that's great. I might be able to put you in this house and on paper, you totally qualify for it. But there are times when I say to people, listen, I just want to make sure that you've really thought this through, because what's going to happen is I'm going to get you in this house that you love. And on the third month that you write that check, are you still going to be thinking that I did a good job for you? Are you going to be so financially cash flow strapped that you're going to feel like it's a mistake? So let's walk through this. That's my business model. That's how I talk to my clients. That's also why I don't have a marketing budget. That's why I don't pay to advertise. Like, we got a lead pop site, I dropped $500 and like, I'm choking on it because I've never had to do that before. But that's also why so many people refer to me, because 3 months down the road, 4 months down the road, they still think, and you know what? Sometimes those conversations I've had with people, they come back and been like, okay, so you were right. And this is a stretch. What can we do? And I have to say, let's give it a month. Okay. Like, I have to say to them, like, I have to explain to them an EPO. A lot of times I say, listen, let me go back to the bank that we did this with and see if they'll work with us on this EPO. If not, let's get it started. Let's get your appraisal. Let's get it approved. And as soon as we're outside of that EPO, we'll close it. Unless something happens and you need to close, you like absolutely have to have us close it sooner, right? They don't want me to pay the price for it, but they also know that they can come back to me if they're in a pickle, because they already know that I know. And I tell them, like, if you get in a pickle with something, if something changes, always call me first. Don't go into default. Like, don't, like, I hear this all the time where people are like, I didn't know what to do. And I'm like, you could call me, call them. Like, we could have done something before a payment was missed. Okay. All right. We ran a little bit over. Last call for questions. Otherwise, we're going to close it out. Okay. So no questions. Real quick. Next week is going to be the last week that I'm doing this. Only because, like, I'm kind of getting to the point where doing 6 hours a day is really hindering my ability to work in my business with my people. But also because I'm actually going to create like a platform. What do we call it? Basically like an ongoing, like, mastermind, founding member. So people who have been with me, who have registered for my YouTubes, as we move into a space of monetizing this, as a founding member, you guys are going to be able to join and be a part of it and give feedback while we figure it out. We're going to be moving over to a different platform. We've got some technical stuff to figure out. I've got some audio, visual stuff coming in, but I don't want to spend so much time fighting with my Wi-Fi and zeroing out white spots on my whiteboard, because I know that this is valuable content for you guys. I'm also trying to grow the channel. Like, I want to bring more people in. We have such a need for processors. If anybody in here was listening to Barry Habib and Matt Ishbia, like, it wasn't my idea. I was regurgitating what I've heard them say for the last month, which is Q3 and Q4 is going to be crazy sauce. And if we don't start gearing up and getting more people in this industry, we're going to be underwater for 6 to 9 months, not sleeping at night, because we're going to be working. And so I want to be able to create a forum where I can help other people come into the industry who don't have a lot of experience and learn how to do a mortgage. And hopefully what you learn is, like, you don't always have to know a lot about mortgage. You just have to know how to play within the system. Okay. The more you play in the system and the more you know, the better you'll be and the more work you can take on, but you don't have to know it. You have to know how to get through the system. And I think some of y'all are taking on more than you should. I think some of y'all are doing loan officer stuff instead of processing stuff. But if you're a loan officer who's self-processing, then you have to know it all anyway. All right, guys. Okay. Have a great weekend. If you think of something later, just shoot me an email. It comes into my work email box.
Thank you.
Thank you.
You're welcome.
Thank you so much. Have a great weekend. This was an awesome session.
Oh, good. This will be up
Very
Saturday. This one will be up tomorrow.